Okay, we talked about the balance sheet, which basically tells you what you own or who owns your stuff. Now we got to figure out how much money do I make? And so that's called the income statement. And the income statement is basically a statement that tells you about your income. Okay. And the top of the income statement is something called sales, which people also call revenue. And that's called the top line. That's accounting nerd speak for top line. That's sales. And when they say, what is the bottom line? That means what is net income, which is at the very bottom of your income statement, which is why they call it the bottom line. Okay. So in our hypothetical corny example that I created, the Banana Watch Corporation, um, we've sold 1,000 watches. So look at the sales line there. Okay. We sold 1,000 watches at $300 each. That's $300,000 in sales or revenue, same thing. The cost to make those watches we sold is about $200 each. So $200 times 1,000 watches is 200 grand. So sales minus the cost of goods sold, or COGS, sales minus the cost of goods sold, is 300 grand minus 200 grand. And that's 100 grand. And that's called gross profit. Don't ask me why the accounting idiots call it gross profit. It is what it is. Okay. It's just profit that's gross. I don't know why it's gross profit. Stupid. So that's 100 grand. And then below that, we have all these other expenses, and those are called operating expenses, or the cost to operate our business. And they're, sales and marketing, S&M, R&D, research and development, and also other expenses like G&A or just general expenses. And then you've got something called depreciation. And this is messed up, man. But you're allowed to deduct the cost or the amount you used your machine or car each month. Okay. And that's how much it depreciates, like wear and tear. What is the wear and tear on your car? It's so crazy, but you can deduct it, right? And it's awesome you can do that. And I'll tell you why. Because the government wants you to invest in your business by buying more machines or more cars. And so the tax benefit is this. If you can deduct that as an expense each month or each quarter, depreciation expense, even though it's not real, then the tax you pay is lower, right? Okay, so sales minus the cost of goods sold is gross profit. Gross profit minus the cost to operate your business, like sales, marketing, general expenses, R&D, depreciation. That equals something called operating profit, or earnings before interest and taxes, or EBIT, EBIT, earnings before interest and taxes. And you're saying, why the hell do I have to know about earnings before interest and taxes, Chris? Why don't you just go to the bottom line, go to net income? Well, you can't. Why? The reason is because every country in the world, and every state, and every industry, and every company has a different way of paying taxes. Everyone pays a little bit different taxes. Just like you pay different tax than somebody else does in your class or in your company. I pay different taxes than my neighbor. My parents pay different taxes than me. Why do I mention this? Why is it important? Because it's not apples to apples for me to compare the Banana Watch company to a company in Switzerland, for example, where they make inferior watches to our Banana Watch, right? And so in Switzerland, they have a different tax and interest rate structure. And so investors in our Banana Watch company want to understand how our company compares financials wide to the inferior Swiss watches. I'm just joking. If anybody's Swiss watching this, Banana Watch sucks. Okay. So that's how you do it. You look at operating profit or earnings before interest and taxes. Okay. And then what happens is that's called the line, right? It's accounting nerd speak. Don't ask me why. And below that line, you have below the line items, right? So below the line items are interest and taxes, which again are different for every company. And the bottom line is net income. That's why an income statement is set up that way. Okay. So the way it works again is you've got sales at the top. Let's call that A, which is the total of stuff we sold. And then you've got expenses. We'll call that B, which is expenses are rent, wear and tear, marketing expenses, interest, taxes, whatever. So that's B. A minus B is equal to net income. Okay, that's it. That's all it is. Okay, it's pretty simplistic, right? But it's not more complicated than that. That's all it is. And so you might ask yourself, okay, Chris, that's pretty cool. So I've got 30 grand in net income. Obviously, Chris, that means I have 30 grand more in my pocket than before. No, it doesn't. It doesn't. Your cash balance is not going to increase by 30 grand. Why? Why? Because you had non-cash items, okay? Remember, depreciation, that you got a benefit there, right? We got to deduct that. We wanted depreciation on our income statement so that our earnings were less, we pay less taxes. It's a beautiful thing, right? But we need one more financial statement, and this is the last one I'll ever bring up, I promise, right? And this statement is going to tell you what the real cash balance is in your pocket, because net income's a lie, right? And so cash is king, okay? I rule, that little icon there. So we need a third statement. This is the last statement. It's called the cash flow statement, right? Because it's a measure of what cash flow really is. So we're not getting 30 grand more in our pocket. We're getting something else. Let's figure out what that something else is. Okay, so we start with net income at the top of our cash flow statement, right? And then we're going to add back the increase in depreciation, right? Because that cash didn't really leave our pocket, right? We got that benefit from not paying taxes on it. So woohoo, we're up to 32 grand. But hold on a second. On our balance sheet, in the current assets section, there's something called accounts receivable, and that's going to hurt our cash balance. Say what? Well, when you sell something, like we sell our banana watches, we either sell them for cash or we sell them and people pay with their credit cards, right? Why? Because they just want to pay for it later, right? And so that's called accounts receivable. We haven't received that cash yet, so we got to deduct that, okay? So, and then what happened was we actually owed some of our partners money, right? So, we bought a lot of supplies for our watches from a company that makes really cool sapphire crystal, and the sapphire crystal is actually the watch face on our banana watch, right? And so we got 20 grand worth of material, sapphire crystals, but we haven't paid for it yet. That's called accounts payable, right? And so we get 20 grand benefit temporarily here, right? So our net cash flow from operations is 42 grand, okay? And you can see the math there in front of you. And so let me just do a little side topic before moving on here. Everybody in business that you do business with thinks of you like you're a bank. And everybody we do business with, we think of them like a bank. What the hell does that mean, Chris? Well, hear me out here. You always want to pay back your debts as late as you can, as long as you don't incur penalties or pay interest expenses. And everybody else that does business with you, they want to screw you. I don't mean in a bad way, but they want to pay you back as late as they can, as long as they don't receive a penalty or have to pay interest expenses to us. And so other people think of us like a bank, and we think of other people like a bank, right? And the reason you do that is cash is king. You want to hold as much cash as you can for as long as you can, right? And the interest rate benefit is great. So let's assume interest rates were 12%, okay? And they will go up because we'll never get lower interest rates than we have right now. So they're 12%, right? That means if I pay everybody back a month later than I should without having a penalty, that's an extra 1% benefit I get that month. Times 12, that's 12%. So anyway, you get the idea. Okay, so we talked about cash flow from operations. Okay, so let's talk about cash flow from investing. Okay, so we bought a machine. We paid 40 grand for it, right? And so we invested in our company. And so that's going to hurt us. We lose 40 grand there, right? But we actually have cash flow from financing of 20 grand because we got a loan for 20 grand. So that's more cash in our pocket, right? It's not a good thing. It's just more cash for now, right? So if we net all that stuff up, and that's a $22,000 increase, not a $30,000 increase, okay? And so our beginning bank balance for cash from our balance sheet before was 60 grand, and now our ending cash balance is 82 grand, okay? So last little thing I'll say about these financial statements is all three of them are related, right? How are they related? What is the common element or the link between all three of them? Well, this is a little bit small for you to see this image, but let's just talk about the links. Okay, so net income from your cash flow statement, which is at the top of your cash flow statement, comes from the bottom line or the bottom of your income statement, okay? The link between the balance sheet and the cash flow statements is as follows. The cash balance at the beginning of the period is at the bottom there, or second to the bottom line in the cash flow statement, is also on your balance sheet, okay? And then lastly, net income from your income statement or the bottom line is also reflected on the balance sheet in equity. Okay, what? Well, your net income each month or loss gets reflected in equity. Okay, it just is what it is. Do I want you to understand that? No. Do I want you to create financial statements from scratch ever? No. Whoa. What is this, Chris? Well, this is a modern course. And you don't need to do those financial statements yourself anymore, right? It's a waste of time. It's a waste of time because software does that for us now, okay? And so take a look at the chart there. The x-axis is time, the y-axis is the size of the firm, small firm, medium firm, too big firm. And I've started a couple of companies, and I've used QuickBooks for all my accounting stuff, and it is awesome, okay? It is awesome. How does it work? You do two things. It asks you for cash in and cash out. And so you input all that stuff into QuickBooks. Or if you don't use cash, you use credit cards and everything, which I do, you get all your credit card statements and your bank account statements linked directly, electronically to QuickBooks. You enter in nothing, okay? It's awesome. And then what you can do is you can go up to the menu in QuickBooks and say, build an income statement for me, or build a cash flow statement, or build a balance sheet for me, right? And then what happens is it sends it directly to your accountant, and your accountant takes care of your taxes for you. It's so amazing. Or what I also did was I had employees, and I would pay my employees automatically using QuickBooks, right? It would send money to their bank account from my bank account. And it's so awesome, QuickBooks, because it actually sends state, local, and federal taxes directly to those government agencies for payroll. And it sends all the tax statements related to payroll to all those agencies directly for you. So you don't have to worry about it at all. It's amazing, right? So, and then what happens is when your company gets bigger, say you're in year 5 and you have, I don't know, 200 employees, 300 employees, you're too big to use QuickBooks, right? So you're going to graduate, right? You're going to move up in the world to NetSuite. And think of NetSuite as Microsoft Office for the whole company in the cloud. So just like you have Word, Excel, PowerPoint, NetSuite, you've got accounting stuff, human resources stuff, inventory management or procurement stuff, manufacturing stuff, and they all talk to each other, okay? And then when you get really big and too big, and the firm shouldn't be that big, because big firms can't really grow large numbers. Then you graduate to something called SAP, which is a big German software company, which makes very robust ERP or enterprise resource planning software products. Oracle makes that stuff too. So all that stuff I just taught you, it's important to kind of understand high level what an income statement is, what a balance sheet is, what a cash flow statement is. Do I want you to create them all from scratch over and over again for the rest of your life? No, because software does it for you, okay? Go to QuickBooks Online and check it out if you want a free demo. It's pretty cool. Okay, so let's talk quickly about financial ratios, okay? And I want you to understand financial ratios. I don't want you to memorize them, right? Again, I was very honest with you. The first time I took accounting, I got a D because I didn't understand financial ratios. I memorized them, right? Hopefully this isn't boring for you. This year, thousands of men will die from stubbornness. No, we won't. Sorry, I'm trying to break it up, make it funny. When I teach the business school classes I teach, and I actually have a lot of videos in between and jazz it up to make it fun. You can always pause me and never come back to me again. My students are stuck though. Okay, so why do we care about financial ratios? Well, there's 3 reasons. Remember the power of 3? All right, number 1, we care about financial ratios so that equity investors can decide to invest or assess the investment performance of our firm. Right? How are we doing? How is our debt structure? Do we have too much debt? Is our revenue growth good enough? Right? That sort of thing. Number 2, the second reason that ratios matter or are relevant is so that lenders can decide to lend, or they can assess how their loan performance is doing with us. More on that in a minute, okay? And the last one is so that business owners can track performance. How's our banana watch company doing? Is our inventory too much? Are we selling as many watches as we thought we would? Whatever. Okay, so ratios don't really matter much until the B round, okay? Because early on you don't have much stuff to sell anyway, okay? All right, so the only ratio that matters early on for a company is the cash burn ratio. Cash is king. And startups are analyzed on a monthly basis on their burn rate, their cash burn rate. How much cash are they burning, per month early on? right? And early on, it's your friends or family that might give you money, and then the first venture capital firm, and then God forbid a bank, but you might have something early on. I hope you don't. And then a venture capital firm, number two, will lead your B round. And then later stage, you'll have another bank or an investment bank or a mutual fund or hedge fund will own you when you're public. And the private equity firm like KKR will pull you apart and take you private. Don't worry, we'll cover all that stuff later, right? But cash flow is very important towards the end of the process, much more so when companies are taken out of circulation. I'll explain that later. So let's look at trends and ratios for the Banana Watch Corporation. So I know it sounds nerdy, but I want you to learn to enjoy reading financials like a good book. Okay. One data point does not make a trend, but a couple do. And I want you to look for patterns. Okay. It's actually fun in the financial statements. Okay. So these are a bunch of red flags here, right? So sales growth, we can see here from our income statement. Between year one and year two, sales grew 25%. Woohoo, that's great. Sounds good. However, we're going to look at every other line item to see if good stuff or bad stuff is happening. So green is good, red is bad. Okay. So 25% growth is good, right? However, gross profit margins, meaning gross profit divided by sales, went from 35% last year to 34% this year. Yeesh, that's a red flag. We're becoming a little bit less profitable, right? Marketing expenses went from 10% of sales last year to 11% this year. Yeesh, that's a red flag. Employee-related expenses went down a little bit from 7.3% to 6.8%. Okay, that's good. And if we go down to EBIT, or earnings before interest and taxes, right? EBIT divided by sales, or operating profit, went from 10% of sales to 8.6%. Yeesh, that's scary. We're becoming less profitable. And then what happened was our net income, you go to the bottom line there, net income divided by sales, or profit margins, right? Net income divided by sales. Usually when you talk about margins, it means stuff divided by sales. So our profit margins, profit divided by sales, went from 5.1% last year to 3.6% this year. Yeesh, that's a scary ratio. That's a red flag, okay? Now, if you look at, this is a balance sheet, right? Our balance sheet. Let's analyze this really quickly, right? Look for trends. Yeesh, looks like our cash balance went down $20,000. What the hell is happening, right? That's bad, right? And our inventory went up $110,000, should say thousands. Why is inventory going up? What's going on here, right? And we can look at, well, what's financing inventory? We couldn't have just used $20,000 to finance an increase in inventory of $110,000, could we? Well, let's just look down the rest of that balance sheet and find out what's going on. Okay. We got a $20,000 short-term loan. So our short-term loan went up $20,000. I guess we were financing the increase in our inventory by getting a short-term loan. And we got $40,000 increase in long-term loans. We went from $20,000 to $60,000, right? So we're financing, sorry about that. We're financing our inventory by getting loans, right? That's kind of scary, right? So something is off here. And so the link between the income statement and the cash flow statement between the balance sheet and the income statement, you see that little link logo. My kids play this game called Zelda. That character's name's Link. We can see that that link is there. We had $30,000 more on our income statement, which is not cash though, as we know. So when cash is declining, this is a deadly red flag. Cash is king. So most companies go belly up because they run out of cash. You got to monitor cash closely when you look at financial statement analysis.